Welcome back to All About Economics. Today we tackle two things, one that sounds like a gift but is not, and one simple idea that literally built the modern world. First, bonus shares. Your company announces you are getting extra shares, completely free. It feels like cash just appeared in your account. But is it really free money? We will crunch the numbers and find the surprising truth. Then we will zoom all the way out and ask where shares even came from, and discover the elegant invention, the share of stock and limited liability, that made giant companies and modern capitalism itself possible. Let us dig in. Section 1. The free money feeling. The word bonus alone gets an investor excited. Your company says you are getting more shares, and you do not have to pay a thing. It totally feels like a windfall, like free money landing in your account. This is the million-shekel question. Is that really what is happening? The honest answer, which we will prove with numbers, is no, not quite. A bonus issue is real and it does something useful, but it is not the windfall it appears to be. Understanding why is a wonderful lesson in seeing past the surface of a financial event to the underlying value. Exactly the skill this whole finance track is training you to develop. Section 2. What a bonus issue is. So what is a bonus share? It is exactly what it sounds like, a company issuing brand new shares to its current shareholders, completely free of charge. The number you receive is based on how many you already hold, in a fixed ratio. For example, a 1-for-2 bonus issue means that for every 2 shares you own, you receive 1 new one. So if you held 200 shares, you would suddenly hold 300. More shares, no payment, distributed in proportion to existing holdings. On the surface, your share count just jumped by 50% for nothing. It is easy to see why investors get excited. But to see what truly happened, we have to look at what those shares are each worth afterward. Section 3. Why it is not free money. Here is the key, and it echoes the rights issue. A bonus issue creates new shares, but it does not create any new value in the company. The factories, the cash, the profits, the actual business, none of that changed when the bonus shares were printed. So the total value of the company is exactly the same, just divided among more shares. Each share is therefore worth proportionally less. It is like cutting a pizza into more slices. You have more slices, but not one extra bite of pizza. If you own 2 shares worth 30 shekels each, 60 in total, and a 1-for-2 bonus gives you a third share, you now hold 3 shares, but they are worth 20 each, still 60 shekels in total. Nothing was added. Section 4. The numbers. Let us prove it with a concrete case. A company has 200 million shares outstanding, trading at some price, giving it a total market value. It announces a bonus issue that increases the share count, say by 50%, to 300 million shares. The company's total value has not changed at all, so to find the new price per share, you simply divide that same total value by the new, larger number of shares. The price drops in exact proportion to the increase in shares. Every shareholder ends up holding more shares at a lower price, with their total stake worth precisely what it was before. The bonus issue is, in essence, a cosmetic split of the existing value into smaller pieces. Section 5. So why do companies do it? If a bonus issue adds no value, why bother? There are real reasons. First, liquidity and accessibility. By increasing the share count and lowering the price per share, the stock becomes more affordable to small investors, who can now buy in more easily, often improving trading activity. Second, signaling. A company usually issues bonus shares out of accumulated profits or reserves, so the move can signal management's confidence that the business is healthy and growing. And third, psychology. Many investors simply like holding more shares at a lower price, even though the total value is identical. So a bonus issue is a tool for marketing the stock and signaling strength, not for handing out free wealth. Section 6. Where do shares come from? Both bonus shares and rights issues raise a deeper question we have so far taken for granted. Where did the share, the stock itself, even come from? To answer that, we have to travel back 400 years, because the share of stock is one of the most powerful inventions in all of economic history. It is the idea that built the modern corporation, and with it, the modern world. And like most great inventions, it was born from a seemingly impossible problem, one that no amount of ordinary thinking could solve. a problem of enormous ambition colliding with enormous risk. Section 7. The genius invention. Picture the 1600s. You have a vision of global trade, fleets of ships sailing the world. But it is staggeringly expensive and insanely risky, far beyond what any single person, or even a handful of rich merchants, could ever afford. And the ships, along with every penny invested, might sink to the bottom of the ocean. This was the exact challenge facing the Dutch East India Company. Their solution was genius. They invented the share of stock. Instead of one person funding the whole venture, they split ownership into many small pieces, shares, that anyone could buy. Hundreds of people pooled their money, each owning a fraction of the company and a fraction of its profits, and each bearing only a fraction of the risk. Section 8. Why limited liability changed the world. But the truly revolutionary part was a companion idea, limited liability. It means that if the company fails, an investor can lose only the money they put in, never more. Their personal home, their other assets, are safe. Think about how this transforms risk. Suddenly, ordinary people could invest in a wildly risky venture knowing the absolute worst case was losing their stake, nothing more. This unlocked vast pools of capital for ambitious projects no individual could fund, from trading fleets to railroads to the technology giants of today. The combination, dividing ownership into tradable shares and capping each owner's risk, is the foundation of modern capitalism. Every stock you have ever bought is a direct descendant of that 400-year-old stroke of genius. Conclusion. We have demystified the gift that is not, and uncovered the idea that built the modern economy. A bonus issue gives you more shares, but no new value. The same company sliced into more pieces, so your wealth is unchanged, though it can boost liquidity and signal confidence. And the share itself, with limited liability, was the elegant invention that let many people pool capital for huge, risky ventures while risking only what they invested, the foundation of the modern corporation. Next, we turn to the most exciting and misunderstood instruments of all, options. If this gave you a new appreciation for the humble share, please subscribe to All About Economics and share it. See you there.